big banks. Now, this is the first time I can remember in a long time where all four of the top biggest banks are reporting on the exact same day. Usually there's one that's like, everybody else reports on the Thursday and the Friday, and they're reporting on like Monday or something crazy, but they're all four going on the same day. And then I threw in First Republic too, because they're also going on this Friday. So what is happening with the banks? I expected them to be one of the big winners last year in 2022 as the Fed raised, but instead they were among the big losers. So let's take a look at some of these charts. Who has the good earnings surprise outlook? What is happening with them? Are they cheap? Should we be diving in? Let's take a look. So the first one I chose, it's not the first one going off since they're all going off on the same day, but it's Bank of America, ticker BAC. And as you can see, they've got a pretty good earnings surprise track record, just the 3 misses in the last 5 years, and they've all come post-pandemic, post the start of the pandemic there in 2020. So it's not really, all that important on the meet or the beat with the banks, but obviously you'd like to see more beats than meets. Now, these shares are down 31% in the last year. You can see them kind of bouncing around there in the second half of 2022. They're cheap. And this is one that's going to tell us a lot about what's happening with the U.S. consumer right now, because they do have their hand on the pulse of that. So Bank of America yielding 2.6%. That's the second lowest out of the dividend yields of these 5 banks I'm going to talk about today, but still not too terrible at 2.6%. So this is going to be an interesting one. I own it in the Zacks value investor portfolio. And, as I said, these big banks are cheap. So let's switch over to JPMorgan Chase. This is one of the leaders, as we all know. And this one, JPMorgan, is down just 17% over the last year, thanks to this mini rally we had going into the end of 2022. Now, they too have a pretty good track record. They have 3 misses since the start of the pandemic, and then just that 1 miss back there in 2019. So the earnings beat and misses is not really an issue with JP Morgan. It's yielding 3% here, so a little bit juicier than Bank of America. What will Jamie Dimon tell us is happening with the American consumer? That is always key. It's always really about his outlook and guidance and what's happening with, credit quality and things like that. Those are all things to watch with all of these banks. Then we're going to switch over to Citigroup, ticker C, probably, possibly the most international bank out of all of the 5 today. And so it trades a little bit differently because it's more impacted by what's happening in the global economy. But as you can see, it's got a great earnings surprise track record, no misses, even during the pandemic. That's an earnings all-star, but the street hasn't really cared that much. Over the last year, shares are down 27%, like a lot of these banks. You can see it really peaked there in like early to mid 2021, and then it's just been on a downward slope. Shares are cheap, and you get the best dividend, yielding 4.4% now. That's pretty cheap, but I'm a little bit wondering whether or not these shares are going to round trip back to those coronavirus lows. I don't know. That's a little surprising for these banks, given that the global economy is nowhere near what it was in 2020. But Citigroup could be on a massive sale here, but we'll see what they say this quarter. Then we're going to continue on with Wells Fargo. And Wells Fargo was the bank that had the most trouble going into the pandemic. You can see the 2 misses there right when the pandemic started, and then 1 miss last year. But Wells Fargo seemingly has turned it around a bit, at least on sentiment, because those shares did rally big in 2021. A lot of that was due to its huge mortgage business and the hot housing market. And now they've had to lay off some of their mortgage brokers because the housing market has stalled as the rates have risen here. So what's going to happen with them? There's a lot of balls in the air here. Over the last year, shares are down 22% and they're yielding 2.8% now. But Wells Fargo, might not be as cheap as some of these other banks now that everything's been priced in. And now I forgot the fifth chart here. First Republic Bank, I don't want to leave it out. It has a great earnings surprise track record with no misses there during the pandemic. It just had those 3 misses back then in 2018 and 2019 there. And then it's been perfect ever since. So that's impressive. But First Republic Bank, if you've never heard of it, it's headquartered in San Francisco. It's a Bay Area bank. It does a lot of wealth management. So while the stock market was booming, that's when these shares will boom. The assets under management boomed. And now that things are getting a little dicey, especially in the Bay Area, and the stocks, especially of NASDAQ, listed companies, tech related, are down there, then the stock has fallen. So 1 year, these shares are down about 39% now off their high. And it's always been among the more expensive of the banks because it was considered kind of a growth bank. And so now, even with the pullback, it's trading at 17 times. And banks don't usually go off of PEs the same way other companies do, but that's still high on a PE for a bank. So what will happen with these shares? Are they going to round trip back to the 2020 lows? Unclear here. You do get a dividend, but because it's more a growth name, they've never paid the big yield. But with the big sell-off here, it is now yielding 0.9%, so almost a percent now, when it used to be really low, like 0.3% back in the booming times of 2021. So First Republic, interesting because it's kind of a guide on what is happening with the technology industry and just the wealthy in the Bay Area, but that is a big concentration of wealth there. So I like to see what's going on and what is happening with the growth side of things on the banks. So for all of these banks, guidance is probably going to be even more important than the actual earnings miss or beat. So a lot of people are going to be disregarding the, what happens in the actual day with the green arrow or the red arrow. But what are they saying? What are they seeing in the credit quality? What are they seeing with the consumer behavior right now? These are all key things that are going to drive the rest of this earnings season. So this is an important week for earnings, even though we're getting mostly just these big banks and a few other select names, including an insurance company and one of the airlines. But it is going to kick off what is considered to be one of the more important earnings season in recent quarters, and especially is going to lay out what is happening out there in the economy in 2023. What is that guidance for this year? And we're about to find out. So you don't want to miss a single earnings all-stars. I'm bringing them to you all earnings season, and things will really pick up next week with a lot of the bigger tech names. We're going to get a lot of the large caps all in a row. So be sure to get us on Zacks.com/YouTube. I'll be tweeting out the YouTube videos and more charts. So if you want everything earnings, just come over to Zacks.com, click on the earnings button. You'll see our articles. You'll see the earnings calendar. You can find our charts. Everything is there, but be sure to join us. And I'll see you again next week with some more earnings charts.